Hello, everyone. Here's a quote before we get going. Be fast, have no regrets. If you need to be right before you move, you will never win, said a World Health Organization expert in March of last year. So good day to you wherever you are in the world. It's 1:30 p.m. UK time on 15th of June, and welcome to this webinar brought to you by the Chartered Banker Institute. To our members and fellows and those joining from our Chartered Alliance partners at CII, the insurers, and CISI, you are all very welcome today. In this webcast, you will be able to ask questions using the usual channel on the forum, and we will endeavour to get to those as best we can. Unless, of course, you're watching on catch-up at a later date, and I'm only too aware that we can't answer your questions at that time. So please sit back, relax, and enjoy what we have in store. Now, since the global pandemic took hold some time ago, and there is a debate about how long ago that is, for us in the UK, it's certainly been since around February, March of last year. Almost 4 million souls have lost their lives globally, and each of those is a family facing loss. Last week in the southwest of England, the G7 leaders met, and amongst other things, they agreed to collectively donate 1 billion vaccine doses to those in need. And the week before, the G7 finance ministers met to discuss a global tax rate for multinational companies. Now, in January of this year, just some months ago, we gathered a panel of experts to look specifically at the emergency loan schemes for UK businesses, specifically under BBIL. We also welcomed an international fellow of our institute to give an Asia Pacific view from Australia. So many of you we know nowadays are based out there, and we suspect you might be watching on catch-up, but Joseph is staying up very late in his day to join us. So a special good day to those connected with Finsia down under. To have a rethink and look at where we are today, and because they played so nicely together and wrote lovely thank you letters, we invited them all back. And in spite of last time round, they all accepted. So with us today from corners of the UK and in Australia is a group which bring over a century of experience to our discussion. No one in particular has more years than anyone else. It just tells us that we are in august and serious company. Now, Jane Fuller is a graduate of Cambridge, is a co-director of think tank, the Centre for the Study of Financial Innovation. She's also a visiting professor at City University, a fellow of CFA Society, and Jane is also an honorary fellow of our Chartered Alliance partner, the CISI. As a former financial editor, assistant editor at the Financial Times, you have more than likely read her words on the influential Lex column, or the words of many she has trained there. Also joining us from Australia is long-standing professional banker and fellow of our institute, along with a fellow of Finsia, Joseph Healy. An advocate of lifelong learning, Joseph holds a Master of Science in Finance, an MBA, a Master of Science in International Management, and MA in Contemporary Chinese Studies, which is, of course, really interesting for someone in Australia. He's a published author of 3 books, and of particular interest, his post-financial crash analysis, looking at what went wrong with the Australian banks, and another book, Chinese Firms Going Global, Can They Succeed? I think we know the answer to that question already. And after yesterday's defeat of Scotland by the Czech Republic, Joseph might have been useful given his 5 caps for the Scottish football team as a youth player, only 4 or 5 years ago, Joseph. He was previously a director of football at Federation Football Australia and is currently the co-head of Juro Bank Down Under. Also joining us today, Chris Leslie is the Chief Executive of the Credit Services Association, the CSA, having previously been a Member of Parliament, not once, but twice, and Shadow Chancellor of the Exchequer in 2015, having been a government minister in a variety of finance-related areas over his time. As a member of Her Majesty's Loyal Opposition, he was Shadow City Minister and was Shadow Secretary to the Treasury in the aftermath of that global financial crisis that both Jane and Joseph wrote about at the time. He was also a member of the House of Commons International Trade Select Committee and no doubt interested in trade deals and post-Brexit and everything else, and also a member of the Public Accounts Committee. So we have a collection of individuals, and on my screen on the top right, he may not be there on yours. I also have Stephen Pegg, who is the Managing Director, Commercial Finance at UK Finance, the leading financial trade association. Stephen is also a director of the UK Business Angels Association and a non-executive director of the Business Banking Resolution Service. Now, having read economics at University College London and completed his professional banking qualifications, Stephen was a senior executive at Lloyds in many roles across the bank for more years, Stephen, than I will mention. And of course, you are all very welcome today. So we have two bankers on the panel, a financial journalist and a former politician, which could, of course, be the beginning of a new thriller series for Channel 4, maybe a Scandic Australian noir, or it's the opening line to a very bad joke. So to all four of you, thank you very much indeed for joining us. Now, earlier I quoted, "Be fast, have no regrets. If you need to be right before you move, you will never win." Now, that might equally apply to government when prompted to bring financial stimulus. It was, in fact, Mike Ryan, an epidemiologist at the World Health Organization, speaking in March 2020. That seems so long ago. So, Stephen, before we set the ball rolling, can you tee us up with the state we're in around those emergency financial funding packages in the UK and the timeline between now and, say, the year end, given that we've had a delay to the reopening of England, particularly because we've got the four home nations slightly different from each other? What impacts are already in train? And in the most delicate sense, what are the elephants in the room, both general and BBL specific? Stephen, would you comment?
Yes, Bill, thank you very much. Bill, our very own Andrew Neil, if this was GB News, the technology seems to be working a bit more smoothly. So hopefully it will carry on that way. We're at a kind of point of inflection, really, I think now, with furlough starting to taper from the 1st of July. Chancellor has reaffirmed that businesses will be expected to contribute on a phased basis until that ends on the 30th of September. The commercial property moratorium is going to be lifted. So, you know, where there's rent arrears, there may begin to be some action taken on that. Rates will start to be repayable again shortly. And during the autumn, those deferred taxes that perhaps have benefited from time to pay may start to be expected to catch up as well. And last week we saw the first payments made under the bounce back loans, and because they were so concentrated in their very early period, quite a significant number of those 1.5 million small business customers will be making their first repayment or not making their first repayment. Anecdotally, I can tell you that the news is that most customers have made their first payment where they were due to make that first repayment. Just very early days, obviously with the first week, but some of the members that I've spoken to have said actually the level of missed payments and arrears have been lower than they might have feared. And we have to take that as early green shoots and signs of perhaps it's not going to be quite as difficult as it might have been. But of course, that's only the very first payment. For a typical customer, it's only £60. Those other sources of support are yet to be withdrawn. But nevertheless, have to take that as reasonably good news. At the moment, the market is still quite liquid. Deposits at record levels, having increased by 20 to 30% in the last year, whilst borrowing has increased significantly. So gross SME lending was nearly double what it had been in the prior 12 months in the year up to April, in part due to substantial contribution of the government-backed loan schemes. What we're beginning to see now is actually a more normal pace of lending, with gross lending a little bit higher than it was in the previous year, and most of it being done on a commercial basis. Total outstanding SME lending, 216 billion, compared with 170 billion at the end of April. So, 25, 26% up. Not overwhelmingly high, but when you break it down by sector, you are seeing higher levels of borrowing, relatively speaking, construction, wholesale, retail, hospitality. And of course, hospitality still facing further and extended restrictions, we know from yesterday, than we might have expected, which means that whilst they might be open, they're certainly not operating at capacity. And as Kate Nichols has pointed out as Chief Executive of UK Hospitality, still making losses. So, that is significant. Of course, the travel industry also significant. We will also see, Bill, from the 1st of July, the beginning of the introduction of the import controls that have been put on hold post-Brexit. And I think those could be more, impactful probably than the export ones. So many businesses in the UK may not export, but they certainly do import. And supply chains and the costs of import commodities, as Joseph will attest, I think, from Australia, very high, and restrictions on skills and all the rest of it. So we have, probably a bumpy autumn to go through. We've all been talking about, a bumpy period 3 months away since the middle of last year, but we've been living in a period of perhaps forestalled, disruption, which I think will begin to come to bear. But, out of that, I do take opportunity and some heart, I think, from the greater level of confidence amongst businesses. And those confidence levels are really quite striking. And, if consumers spend and if businesses invest, with, jobs actually still in place and unemployment not rising to the levels we might have feared, then perhaps some businesses can navigate their way through.
Stephen, thank you for that. We'll come to some of those statistics, particularly around the hospitality sector in due course. Chris, it's often said it's better to travel than to arrive, and we seem to have been traveling for quite some time. I'd imagine that your members at the CSA are preparing for this deferred or forborne onslaught at some point later in the year, or are they?
Yeah, well, thanks for that, and thanks, Stephen, also for that tour across the horizon. I think that covered the picture really accurately. And the Credit Services Association, where I'm the chief executive, we are a trade body for a particular sort of set of financial services providers, the debt collection agencies and the debt purchase community as well. So in the pipeline, obviously, as yet, our members aren't involved in the bounce back loan collection process because it's the creditors who've obviously been facilitating the loans and will be in the first business of collecting those payments as they come in. The government guarantee, of course, will compensate for 100% of that, of any creditor losses, but the government scheme requires creditors to use their best endeavours to collect until such point as that is triggered. Some creditors can have their own in-house arrangements. I think there have been various reports about Barclays will be sending out a lot of correspondence to their clients. HSBC have said they've got several hundred members of staff already geared up to have the conversations with their customers and so forth. But some creditors will choose to employ specialist collections agencies who have that capability to engage with customers in a particular way. So it will depend from creditor to creditor. And we're at a very difficult time for a lot of businesses. I mean, exactly as Stephen has said, with the ongoing lockdown arrangements across the UK, at least until the 19th of July, and yet the government, I think, have stood from their point of view in a fairly firm position without extending some of the terms and arrangements to furlough. And of course, business rates are going to have to start to be paid back. Some of the HMRC, other Crown debts will have to be starting to be paid back as well. So although I think some of the data shows that savings are higher, there is a lot of liquidity in the system. There is this sort of sense about what could be around the corner in 6 months and certainly in 12 months time. The dilemma is this, really. The government, I suppose, are wanting to reassert that resources are finite, but that has not certainly been the case over the course of this emergency period. They've absolutely thrown enormous sums of public money into rescuing employees with furlough and businesses with the bounce back loan scheme. I think it's something like over 40 billion pounds in that. And so from the taxpayer point of view, there is an imperative to make efforts to collect, but they will be coming under a lot of pressure from the business community, perfectly reasonably. How can we possibly get into that mode at this particular point in time? So that political tension, I think, is going to continue, and the debate will get louder as we go through July. And a lot of the business organisations will start to say, well, hang on a minute, you've extended the regulations, but not the level of support that's there. And the Treasury are going to have to explain why they aren't providing that and explain that fundamental about limited resources. So they have already specified a certain level of prescribed forbearance that the creditors can offer, something known as this pay-as-you-grow scheme, which are is a sort of bit of a drawdown menu for customers who are finding things difficult to opt for. So for example, they can convert the 5-year term to a 10-year term. They can opt for a payment holiday at some point along the term of, I think, 6 months, or go for a 6-month interest-free period. Again, those are all options that are there. I'm wondering whether there will be even more forbearance options that will evolve over time. I think in many respects, I personally think the best sort of forbearance comes in negotiation and discussion between the borrower and the creditor, and relates to the individual circumstances of the business. That tailored approach to forbearance is, in my view, much better attuned to resolving debt issues rather than having it come from the Chancellor of the Exchequer downwards. So I think that's where the debate may well go next.
So we'll come back to that, Chris, because there's a forgiveness program in the UK and in the US rather, and there is a huge difference, a gulf between forbearance and forgiveness, particularly for the lender. And when the lender is propped up by a government guarantee, it goes straight to the heart of the moral hazard, which we discussed last time round. Now, Jane, if I turn to you, ever the practical journalist, with your nose for fact-based stories, what do you see as the strands and themes then from what you've heard already?
Well, I think, Bill, you're absolutely right. In terms of a journalist, you have to move fast, and you don't need to be right. I mean, at this stage, there are so many conflicting messages, and we just don't know. So, Stephen talked about an inflection point, and there's the, as Chris was saying, the whatever hasn't hit the fan yet in some ways in terms of his members getting involved in the collections when things have gone bad. Actually, at this stage, you're actually trying to cover that gamut. So, you'll have the shock of the UK hospitality industry after the 1 month extension to restrictions, which, immediately they could put a bill on that of £3 billion in lost sales. Others are beginning to report on the amounts they're going to have to start paying in rates, hundreds of thousands of pounds. Then we've got the rent, the whole rent issue. Quite a big number somewhere for the amount of rental debt. Is it a couple of billion pounds?
Yes.
So there's plenty of shrouds to wave actually on the one hand, but on the other, you've got this made in Britain sort of network has been absolutely going gangbusters. You've got manufacturing doing, recording some of the best figures in terms of, rebounds growth for decades. And you've got the unemployment, unemployment going down and employment going up and earnings going up. So you've got, a whole range of good news, or it's not as bad as we feared, as has been said. So at this stage, you have to cover that range. And it's far too early to say because, as has been described by Stephen, they're only just beginning to A, start paying things that they haven't been paying, and B, stop getting some of the support for furloughed workers that they were getting. So, there's a long way for this to run. There'll be some nice niche stories. We've talked in the past about fraud. Will it now emerge how many people got bubble loans nefariously? We also, in terms of the labour market, we don't know how many people are, staying on furlough, but actually have really found another job, and which might explain some of these tightnesses in the labour market. It helps to explain some of that. In terms of the banks, we certainly don't know, and Chris's colleagues, we certainly don't know whether banks are going to go from heroes in terms of, sort of handing the money out to villains if they are heavy-handed in collecting it. And that's quite a big reputational risk. And we don't know what the dynamic's going to be between the government, who wants to minimise the extent to which it has to step in and make good with the guarantees. How much pressure are they going to put on banks to try and get the money back to minimise that bill? So there's a lot of other types of trend stories that one would be looking at as well.
So you're looking into a rather cloudy crystal ball with contra indicators, which would be indicative of a change point, an inflection point, as was mentioned earlier. So Joseph, please lift our gaze from that UK-centric position, brighten our moods. I know it's getting on for quite late in Australia. All is well in Australia, surely. Exports of commodities going, I think the phrase that I heard earlier was gangbusters, recovered oil price for your West Coast players, inflation cranking up a little, and that interesting dynamic from your political leaders in China, domestic consumer market. Is it all fantastic, or are the clouds gathering down there?
Well, it's a mixed story, Bill. I think the headlines are certainly very encouraging. Many of the themes that Steve and Chris and Jane have touched on are true too of Australia. We are pleasantly surprised at just how well we've come through, the business community has come through the whole COVID period, of course, which we're still in. But we saw business confidence at a 11-year high in April. The GDP statistics shows that the economy is now back or larger now than it was pre-COVID. The government's forecasting and the OECD are forecasting a 4.5 to 5% GDP growth over the next 12 months. There's been very little in the way of business distress. I mean, I certainly, as were others, quite pessimistic about how the business community, particularly the SME economy, was going to cope with the COVID environment. But they have done so remarkably resiliently, and you know, banks that were building up provisioning a year ago have started to unwind some of that provisioning, and certainly, you know, in the bank that I look after, which is an SME specialist bank, we've seen very little in the way of financial distress. So it's almost too good to be true that we should go through a period where there's been such dislocation in the economy, and particularly in the case of Australia, in Victoria, which is the second largest economy, where there's, you know, there was 110 days of total lockdown up till about August, and then there's been periodic lockdowns since then. But the resilience has been remarkable, and you know, your equivalent of furloughs, which is what we call JobKeeper, the government unwound that at the end of March. Unemployment continues to reduce, and you know, so the outlook today is very, very optimistic at the macro level, and it's largely driven by the commodities. I mean, the iron ore prices and other commodity prices, and the insatiable appetite of China, notwithstanding some of the political friction that is very much part of the discourse between Canberra and Beijing. But the big issue, Bill, and you touched on it, and I can just, last week I did a tour of Sydney, Brisbane, Perth and Adelaide, and spoke to lunch, breakfast, dinners and other forums to well over 300 small, mid-sized businesses and their advisors. The big issue is inflationary buildup. You don't see it in the inflationary figures that are issued, official figures, but there is no doubt that there's getting access to unskilled labor is a huge problem. Now, Australia historically, by that I mean over the last 10, 15 years, would have granted about 150,000 tourist visas or visitor visas, largely to young, you know, Brits and other, you know, people who finished university who come and work for a couple of years. With the closing down of the borders, those visas are not being issued, and those you know, young visa holders were working in the restaurants and in the agriculture sector and doing jobs that Australians, frankly, had kind of given up thinking about as being real work. Not respect, and yet what you're finding is that restaurants are only able to open 3-4 days a week. Service stations or petrol stations are shutting at 8 o'clock instead of being available 24/7. So there's a real shortage of a certain type of labor across the economy. Secondly, supply chain problems. You know, the container shipments from, somebody was telling me about a container shipment of building material from Vietnam, which would cost about $2,500 pre-COVID, is now close to $12,000 if you can get it. And so businesses, when they can get a hold of raw material or supplies, are stockpiling. And then the third thing is just the costs are starting to rise. So a very simple example, the cost of laying a brick pre-COVID was $1.30 in the construction industry. That's now close to $4. So I could rattle off a whole range of other examples, but there is undoubtedly real inflation, labor shortages, raw material shortages, and inflationary pressures in a way that we have not seen for 25 to 30 years. And so this is a worry, because how that kind of works its way through into the financial system, given that we have a central bank that has officially said that it's committed to keeping interest rates low for the next 3 years. And you know, to what extent the central bank policy and market forces cause the sort of dislocation that we've seen in history before. I'm thinking about Norman Lamont and back with George Soros many decades ago. But I think these tensions and the inflation pressures, of course, have been talked about everywhere else in the world. But you know, I kind of viewed them to some extent as being quite abstract until last week, when I just was hearing it from everybody that they can't get a hold of labor, the costs are going up, and you know, to what extent does that create uncertainty about planning for the future? So that's a kind of mixed narrative. I mean, headlines look great, but some of the underlying trends are quite a concern. And that's before you even start talking about the geopolitical concerns about Australia's relationship with China, given the huge dependency that Australian business has on the Chinese market. So I might press the pause button there, because I say I could.
Well, you know, the parallels are striking for those of us back in the UK, because, you know, we have a similar issue, Brexit, probably driven around finding unskilled employees in the UK. We have a similar issue around our big trading partners because of trade deals and exiting the EU. And some of those concerns about commodity prices are absolutely being faced here. Most commodity charts, whether it be lumber through to wheat, whatever it may be, from left to right, they're going up very quickly. Although I did note, ironically, with the exception of rice, which is flat, pretty much flat year on year. Just some statistics in the UK, which probably play back, Joseph, to what you've said. Then, Stephen, I'll come to you again. 21%, 1 in 5 hospitality workers in the UK remain on furlough. And with the news last night, they are unlikely to be coming off furlough for the next 4 weeks anyway. But conversely, there are 50,000 vacancies in the sector. Now, that in itself is completely juxtaposition. Also, according to the Office for National Statistics, there are 600,000 vacancies across the UK economy as a whole, even though we've got 2.1 million people on furlough. Now, that's down from the 3.4 million peak at the peak of the pandemic, but 600,000 vacancies, 2.1 million on furlough, goes straight to the point that Jane was making, that there are maybe some people on furlough who are actually working, and all sorts of stuff going on there. And there may also be some nefarious situations around B-bills, but we know from reading the press that there are already well-publicised cases of fraud that will be coming to light quite soon. Also, the growth point that you mentioned, we'd like growth, Stephen, as you said, there's a pay-as-you-grow, but not too much growth because it's inflationary. And a 1% move on interest rates in the UK adds 25 billion to the Chancellor's interest rate bill on gilts. So, Stephen, when you sit looking across all of that and drilling down into the lending position as you see it, is it just simply the usual problem that when you deal in averages, it's very, very risky, and there are lots of specifics that are proving the point? Is that a fair observation?
Yeah, I mean, if you've got a foot in a bucket of boiling water and a foot in a bucket of ice cold water, on average, you're comfortable, aren't you? That's you know, never a great place to be.
You're still wet.
And we know that SMEs are the most diverse part of the marketplace. So, you know, I do some work around creative industries, and you know, you've seen the games manufacturers do fantastically well. But if you're in live events, you know, it's been a terrible time. So, you know, there is a whole load of difference under the surface. We've always relied upon the fact, though, that small and medium-sized businesses can be agile. And what we have to hope, I think, is that, you know, there is a willingness and ability for businesses to change and markets to adjust sufficiently to tap into the opportunities and now enable people to kind of move to where the market is going. In terms of skills, you know, from a worker point of view, you know, we will see how things unfold once the safety blanket of furlough is taken away. But it is a bit of a seller's market at the moment. And certainly people who worked in hospitality, who found something else to do, may be understandably reluctant to go back and work in hospitality when they think, when's the next lockdown coming? You know, is this going to be a secure job for me? I've found something else which is kind of more, more stable and rewarding to do. Equally, there are going to be great opportunities within, all the sectors. So, I think the job of the financial industry is going to be to enable businesses to adjust. And we have some kind of longer term trends which are driving change as well, not least the urgency of adjusting to net zero, which is going to be a big deal in the property sector. It's going to be a big deal in transportation, but also a big deal for any small business in a large business's supply chain who's going to be very conscious that they're going to need to be reporting on all of this. So we have a period of change to come, which traditionally has required investment, but the investment is not necessarily going to be in, the sort of areas which traditionally banks have had fixed asset security around. It will be in the short term working capital finance as liquidity tightens, and then investment in research and development, in transformation, in change, and the sort of things which require a bit of a reliance on cash flow forecasting. And there I do think actually government guarantee schemes are going to continue to have a requirement. In the UK, we have RLS, which has taken over from the previous schemes. In theory, that ends at the end of the year, but we're going to need to think about what comes after it. Because I think, as in much of the rest of the world, actually, with the SBA loan scheme in the US, with many European countries, KfW in Germany, there's been a bigger role to play for guarantee schemes to help enable commercial lending to deal in areas of kind of slightly more difficult to kind of judge risk situations than we've seen in the past. And of course, equity has got to play a bigger role. So capital markets, which typically, and as you mentioned, I'm involved with the UK Business Angels Association. I've been closely involved with BGF, the Business Growth Fund in this country. I think, we will need to make sure that that works well. And again, there's a demand side of that. So I think lots of change to come, lots of opportunity, and a continued need for collaboration, really.
So almost a wholesale recapitalization, and of course it's easy if you just simply dress up as a SPAC in the US market. Say you'll buy something on the never for the next 2 years and go out and raise $1 gazillion at the drop of a hat. Chris, do you feel a pang to be a lawmaker again for a third time, given that you must look at where we are now, and this pace to do something rather than do nothing has left a wide chasm, perhaps, between what Parliament's doing and the ruling party, et cetera, et cetera. Do you look at it with envy or relief these days?
I think there are some pretty. It's a time where politics is going to have to get pretty fundamental, because on the one hand, there is a short-term need for government safety net and support beyond the norms of the welfare, suite of interventions that you might normally have. And some of those sectors that Stephen was pointing out, where they're going to have to focus on net zero and all the rest of things, are the very ones struggling the most. So Stephen mentioned sort of, transport, commercial property, who need to be perhaps most transformative, and yet their customer base has been completely crippled by the pandemic. So on the one hand, you get this real drive for government activism, intervention, higher level of state spending, question monetizing finance, this rather blurred interplay between monetary policy and fiscal policy. You can already see that starting to bubble up in all of the developed countries. Just as in Australia, the Fed in the States sort of signaling it's going to try and keep things lower for longer, but their inflationary pressures are already sort of coming through. Similarly, here in the UK, we are expecting, I think, consumer price index on tomorrow, and already being hitting over 2% possibly. So we'll have to see where those things go. So you've got government activism. But then, of course, you've got the other sense in which can governments, pick winners, allocate resources in a fine way, or do you really need to let the market come back in and have some degree of natural choice and settlement so that innovation can proceed and you're not stifling that? That's a very, very difficult set of choices for politicians to articulate. But at one level, you do have to sort of, when this sort of sugar rush of government support does wane, and we're left to see what's standing and what's having most difficulties, that will give us the truer picture. It's always very dangerous for politicians to turn and face the loudest voices. There are some I thought it was very interesting, Andrew Lloyd Webber threatens to, break the law unless Cinderella can open in the West End. So, Boris Johnson finds a way for Cinderella to go into a experimental, pilot scheme.
Oh no, he didn't.
Oh no, he didn't. Oh yes, he did. Oh no, he didn't. And you just think, this is not a good way to run strategically a country and an economy. Albeit you have to, of course, be sympathetic to those competing voices and the pain that is genuine. But I think so. If you're asking me, would I want to be going in through that? Well, Rishi Sunak's popularity may be high as he's been giving out the money, but as he's starting to sort of rein it in a bit, I think that the realities will sort of come home to roost. I mean, for now, we're not seeing, as Stephen said, that massive level of impaired debt that you might have expected a year ago at the beginning of this crisis, when we all thought, oh my goodness, pandemic, people are going to be really having to dig deep, and you're going to see debt at very high levels. The government's level of support has been so phenomenal that actually it's in some respects been fueling the housing market and all these other things that are there. But the moment of truth comes when that is tapered away, if the politicians are able to have or feel the need to do that and can do that. Is there a political strength to do that? Well, the G7 was very social democrat at its meeting last week, sort of all agreeing that overly austere approaches a decade ago were perhaps misjudged, and we should just keep the taps running. But if inflation starts to kick in and people feel the pain from inflation, a memory that is perhaps very distant, is not in this particular generation, then there's new political problems can come from that.
So the new political group who are around, very few lived through that. I mean, you mentioned earlier, issues around inflation. Joseph mentioned Norman Lamont, the Chancellor of the Exchequer, moving interest rates more in one day than I can recall being moved over a course of several years, with a very young David Cameron standing on the steps behind him, actually, as his assistant at Treasury in those days. Jane, if I were to come to you today and say, we've got to put together a couple of things for a Lex column over the course of the next few days, reacting particularly to the market site that Chris alluded to, because who guards the guards? Have we become over-politicized in terms of running the economy? So is it there is no invisible hand, there is actually a hand that we can all see. What would you be thinking as the key aspects for a sharp and pointed Lex column for Mr. Sunak to read over the course of the next few days?
Well, I think one of them is on the political front, is that banks have become the conduit for government policy. But I would hope we'd reached peak, banks as political beasts in the crisis phase of the pandemic. And actually, and I'd love to hear the phrase earlier in the conversation, I think from Stephen, lending at commercial rates. We have to get back to normal, and maybe they have to extract themselves a bit from this political embrace, because they're going to have to start doing the as silkily as they can, the dirty work of collecting some money. So I think that and the other thing is that the banks have stayed pretty strong. So unless we see masses of defaults, and actually the small SMEs are not going to move the needle. it's the big ones, it's the Rolls Royces, and that if we get some, we could potentially get some nationalizations. It's the CBILS and the CLBLs that are going to be the real problem for banks if their balance sheets are going to be tested. So assuming that doesn't happen, actually they could be in a better position to start to behave normally, especially actually if interest rates start to rise a bit more, which actually helps them. The other thing I would be looking at is this issue of the initial crisis response was, let's just help companies and individuals to stay, suspend them in animation with furlough payments, grants, and so on. So that when the virus goes away, initially it would have been thought in a few months, they can just restart and things can continue. I think we're now, well over a year later, into there's a different question to pose, which is, are some of these companies zombie companies? Are some people quite rightly moving on from, as you said, insecure jobs in things like hospitality, not brilliantly paid and not very nice, not very social hours. If they've moved on to, Amazon, one of Amazon's warehouses, maybe they think, oh gosh, I'm being paid a bit better and it's 9 to 5 or whatever else they want. So I think there's that. There's also, is the government going to think about how it wants to spend its funds? I mean, one thing that's interesting is this super deduction for investment. So if labour's short and you could invest in equipment that would automate some parts of your operation, now's the time to do it, and you'll get tax relief for that. There's also some well-flagged sectors that have done well, like, apart from the sort of Amazons of this world. Life sciences. There's a recovery in there's this recovery in manufacturing, but the interesting thing there, thinking about what Joseph was saying, is it's one thing to put up your sales in manufacturing, but if your raw materials are costing more and so is your labour, then you're not necessarily more profitable. Indeed, you may still be struggling to make a profit. But I think actually I would be looking at some of the movements from sectors, that struggling sectors to newer sectors, and so on.
So I'm disappointed in many regards. My heart is saying I'm disappointed that we're not going to be writing a column, Jane, about IFRS 9, which
that's being reviewed. That is being reviewed in the next few years. So that
which I think is a hot topic for those who are suffering from chronic insomnia, although crucially important. Joseph, the cudgel was sort of thrown down there. And I would ask, have we reached the point in Australia, and do you see it looking into the UK and what you've heard, where, again, the moral hazard point is arriving, that if the government is quasi-banking or bankrolling the banks and directing the traffic on interest rate policy, and we've got the Fed, it's happening in Australia, it's happening here in the UK, and it seems as though the G7 are certainly as one, if not maybe 1.5, depending on whether you translate the French leaders' French around sausages and whatever else. In all seriousness, though, you wrote a book about the financial crash last time round. Are you fearful of the moral hazard point?
I'm deeply concerned about it. The politicalization of the banking system is a reality. I mean, partly it was the price paid for saving the system from the aftermath of the global financial crisis. In Australia, we definitely had implications from the global financial crisis. Not a banking system in distress, but a government that needed to offer up a guarantee to support a lot of the short-dated funding that the banks had taken on internationally. But the real crisis in the banking system in Australia was the Royal Commission, which was a government inquiry into the conduct of the banks in 2019, which just threw up all sorts of quite disgraceful and appalling cultural behavior within the system. Now, and that really gave the government a license to become much more interventionist in the way that the banks conducted themselves. And nobody in society would have complained about that, because the the important social license that the banks are granted had been violated, and therefore there was a case for much stronger political intervention. Now, that's punishing some largely poor governance and poor culture within the organization. But if you step back from the individual banks and look at the role of banks in the economy, I get concerned about the fact that market failures are being addressed by political intervention, which I think is the point that Chris was making, is not necessarily a recipe that will bear good fruit in the future. The other thing that, and it's associated with this point, is the concept of creative destruction. I mean, one of the things that COVID has done has accelerated a lot of things that needed to take place anyway. Many good, some bad, but it has forced businesses to get off the dance floor of the day-to-day and get onto the balcony of what is this business, what should this business look like into the future. The kind of problems that people just kick the can down the road because there's no pressing urgency. And I think that it would be much healthier for us in the medium to long term to have allowed the natural forces of creative destruction to dictate outcomes not in an uncontrolled way, but the idea that there are businesses operating on business models that are 10, 20, 30 years old, when clearly technology, for example, is transforming the way that many markets work. And then the question that businesses have to face into, and COVID was a great opportunity to do that, is how quickly do we adapt to the new reality, or do we stay stuck in the old reality? And I don't think government should get involved in changing or trying to interfere in a process that is actually quite a natural one, albeit quite an accelerated one as a result of COVID. So my concern, just going back to the beginning of my remarks, is that the whole intervention of government and the way that the banks have almost, I think it was Stephen talked about cash flow lending. I mean, anybody looking at a business today will look at the balance sheet of the last 2 or 3 years and then very quickly concentrate on the cash flows into the future, because the past is no guide to the future. But the big issue, Bill, and this goes back to the Institute, certainly in Australia, and my sense is true in the UK, is that the industry has lost those skills, generally speaking, because when it comes to SME lending, it has defaulted to how much property have you got, rather than let me work through your business plan and your cash flows. And those skills have been, there's been a de-skilling in the industry that's been a feature of decades, not 1 or 2 years. But trying to find bankers who are skilled in the craft of SME banking and the understanding of cash flows and balance sheet P&L and cash flows, despite very impressive academic credentials, those skills are in short supply.
So how do we get to the point where we can identify the winners if there are no losers? Is a point. Joseph, I'll come back to you for a wrap up shortly. Chris, you were nodding. Now you were at the white heat end of things when the aftermath of all of this came through. And interestingly, it was Alistair Darling, a Labour Chancellor, who was involved at the point of the crisis. You saw the sort of aftermath of all of that wearing your political hat. Are you sharing that similar view that Joseph just articulated?
Yeah, I mean, I think there's a pendulum here, isn't there, of how do you get the balance right? I mean, you can have zero state intervention and let the market sort of resolve everything, but there's an awful lot of pain and harm that comes from that. Or you can have a totally artificial government determined set of parameters, and somewhere in between is a sort of happier medium. But it's very difficult for a Chancellor of the Exchequer to, well, for any politician to ever say no to anybody is very hard. But actually, real leadership does involve sometimes saying no, and that is the difficult things are going to have to happen. The government can't continue forever just saying yes, here you go. because I think most of the public do know that we're in this limbo interregnum period really, and it will need to play out. Now I think there will be some strong lobbying for further business support, as I was saying at the outset. I mean, we mentioned the American debt forgiveness scheme. So that the way they've done that is essentially said to small business loan recipients, well, the government will cover some of the principal and some of the interest payments for a certain number of time. So they almost subsidize in that way, rather than doing what some organizations have done, is calling for write-offs completely or conversion to equity. I think the Federation for Small Business was saying convert the loans to employee ownership equity, which is quite a complicated route to go down in my view. But so I think that politicians will still respond to some of those calls, but they're going to have to put a more strategic framework around what they're going to do. I personally think Rishi Sunak, the British Chancellor of the Exchequer, needs to start thinking about, well, what are his modern fiscal rules, his economic policy rules, so that decisions can fit into a framework a bit more systematically, rather than who is first in the queue, because those voices are very loud. I mean, you can see education needs more resources, health service, international development, all very legitimate, but they need to be put into a framework which is a sustainable approach for the longer term, and that involves some leadership.
Well, thank you. One of our viewers was hoping for more granularity around bounce back loans, which is the moment of truth, of course, that we build. So maybe next time we'll be more granular. Just in the final moments of our time together, because I'm conscious that time waits for no one. Stephen, any concluding thoughts from you as a recovering banker and someone who is looking at it now from a slightly different angle? Your closing thoughts.
Yes, I mean, to first of all pick up very briefly on the point about how we recover bounce back loans. It's pretty much how you recover any kind of arrears situation. You'll have a potential for forbearance, some try and negotiate some extended payment terms from customers. Look to restructure and provide additional finance where the business needs that to kind of get over the hump, or ultimately call it in and recover what you can. Without security and without a guarantee for a limited company, you need a bit of cooperation from the borrower. But the final thing I would say is that I think for this next period, there is a customer side to this. We're probably going to have to try and find a way of resetting expectations that actually you don't get, lending with zero interest, no security, and pretty much no credit assessment, in normal circumstances. And that is a kind of, this was an unusual period. So resetting that is kind of a part of the message about getting back to commerciality.
That's probably called equity, Stephen, isn't it?
Well, there's cost to equity as well, isn't there? Secondly, there's confidence. And I think confidence normally comes from certainty. We're not going to have a lot of certainty for a little while yet. So, the alternative basis for that is resilience. So I do think, having the right people around you, the right tools, a bit of headroom in your facility is going to be important for that. And thirdly, trust. And trust is about, relationships that you can rely upon. And the banks do have to balance, following the rules and the guidance and the regulations, from recovering for taxpayers efficiently with good customer treatment. And we do have standards of lending practice. They're all overseen now and have the weight of regulation through recognition by the FCA. But going beyond that, we've got to communicate better than I think we've done in the past. So to my mind, that's kind of the key things to keep our eyes on now. It's a customer agenda.
Thanks, Stephen. Jane, a final few words from you, and it is very few, our time is short.
Yeah, so just to pick up the equity point, I mean, I think there is re-equitization going on, but mostly it's going to be among bigger companies. I mean, we saw rights issues, we've seen more IPOs or placements. And that's a tectonic plate is shifting there anyway because of the rise in the risk-free rate, the government bond rate. So I think we are going to see equity issues, but right at the small end, I mean, what business owner wants to have somebody else owning the business? So actually there, I think it's going to be more back to the original question, that if the business is not viable, and we've had some reform of insolvency laws, it's going to be actually better for that to be sloughed off. Maybe, you know, thanks to the government for coming in with a guarantee, and hopefully for the entrepreneur to re-emerge doing the same thing better or something different. So I don't think equity is really the answer for SMEs.
Thanks, Jane. Joseph, final word from Australia.
I think the question about the role, the politicalization of the banking industry is are the banks private actors or are they agents of government? This is an important big picture discussion that when the dust settles, I think it's one that we need to come back to, because I think it's quite confusing right now. Even as a CEO of a bank, you know, you have the regulator and you have dictates from government as to what they expect of you. I think we need to go back and have a very transparent discussion about just what is the role of the banking system and how should it execute that role.
Thanks, Joseph. Chris, from you before I close.
Absolutely no. I think the big picture will affect the granularity on things like bounce back loan collections. You might not see the connection, but if your Chancellor of the Exchequer is having to clamp down on expenditure and time and difficult circumstances of the taxpayer, then the collections process will have to be fairly firm. The approach I want to see is one of consistency, so that it's fair to all customers, and that we get proper engagement. To Joseph's point, can we make sure that there is that skill and relationship and understanding each individual customer as far as possible, rather than seeing it as a sort of computer-driven algorithmic process?
Well, thanks very much indeed. As we reach the end of our time, and apologies, we're 2 minutes late, although it's better to travel than arrive, as I said earlier, on this Chartered Banker Institute webcast. So thanks to the panelists. So to Stephen, Chris, Jane, and Joseph, thank you. Who knows, we may even do this again in a few months if you're on your best behaviour. For the Chartered Banker Institute, my thanks to Heather, Anna, and to Matthew for planning, organising, and bringing the whole event together. I'll be back with a different panel on the 21st of June, that's next week, specifically looking at the financing and pandemic impacts on SMEs themselves. Details are on the Chartered Banker website, and you can register there, and I hope you'll join our panel then. All that remains is for me to say stay well and goodbye.
Thank you.